Good morning. Welcome to the lecture on capital markets. This lecture is useful for the course of Indian financial system as well as the course on financial institutions and markets, and also wherever we are trying to understand financial markets. This introductory lecture on capital market would be very useful. So let's move ahead with the lecture of today. It is important that the students who are trying to understand capital market through this lecture, they would have seen my previous lectures on what is the financial system and the role of financial system in economic development. That shall be the prerequisite for this course. The objectives for this lecture are that the learner shall be able to, after completing this lecture, the learner must be able to describe capital markets and its functions. They shall be able to elucidate on types of and the structure of the capital markets. They shall be able to differentiate between the capital market and the money market, and they shall be able to describe the role of the regulator in the capital market, that is, Securities and Exchange Board of India. So let's begin with the understanding that what is capital market. As you can see on the slide, it's very simply, if it is understood very simply, it is capital market is the marketplace for lending and borrowing medium-term and long-term funds. Let's go a little bit deeper and understand what actually this means. Capital markets refer to facilities and institutional arrangements through which medium and long-term funds, that is, for a period of minimum 365 days or above, both debt and equity are raised and invested. It provides all with a series of channels through which savings of the community are made available for industrial and commercial enterprise and for the public in general. The capital market consists of development banks, commercial banks, and stock exchanges. Why should people borrow from capital market? Well, capital market provides with many benefits, with that one might not be able to avail through direct borrowing from a creditor. For example, in capital market, finance is available at a reasonable cost. Financial institutions are sufficiently developed and their processes are well established to provide free, fair, competitive, and transparent financial instruments. Capital market is efficient and mostly accurate in providing all necessary information to the investors and borrowers. Beside the benefits to the individual organization, capital markets contribute to the economic development by providing necessary capital for its facilitation. It is believed today that for strong growth prospects in an economy, presence of a strong and vibrant capital market is essential. Let us outline the players in capital market for corporate finance. On the one side of this diagram, we are going to start with corporate. Corporates are operating businesses. They run manufacturing companies, service companies, technology companies, and they require capital to grow and run their operations. On the other side, we have institutions. These consist of fund managers, that could be institutional investors, but also retail investors as well. These are the people that have capital. So the capital flows from the institutions or investment managers who have the money to the corporates that need that money to grow and run their businesses. In exchange, the corporations issue back to the investor bonds, which is debt, or shares, which are equity. And this completes the cycle between the two. Now, in the middle of these two groups sit the investments bank. They are often referred to as the sell side, and they have contacts on both sides of this diagram. They have corporate clients and they have institutional investors clients. Their job is to match the institutional investor with the corporate based risk and return expectations and investment styles to get a deal done. In addition, you have chartered accountant firms, regulators, that would be the fourth category we will talk about in the course. So, to review the four players in the corporate finance from our perspective, we have corporates, institutions, investment banks, and intermediaries and regulators. This is how the primary market works. Let's move on to the secondary market. In the secondary market, after securities have already been issued, they trade between investors. So on one side, you have a fund manager who wants to buy securities of a public company. And on the other side, you have a different fund manager somewhere else in the world, perhaps, who wants to sell those same securities. So that's what trade is facilitated over a stock exchange, but investment bankers get between these clients to help facilitate the trade. So once again, the investment banks facilitate sales and trading and provide equity research coverage to help the fund managers make decisions about buying and selling those securities. This is how the secondary market works. So to recap, in the primary markets, we have banks, corporates, fund managers, and regulators, all facilitating the issuance of securities. And in the secondary market, we have fund managers and banks together to trade securities in the market. This market makes market this makes market liquid, and this is what allows you to get in and out of the securities very easily in this secondary market trading. Let's see what are the functions of capital market, what purposes it does serve to the broader economy of a country or a nation. While from a broader perspective, capital markets is viewed as a market of financial assets with long or infinite maturity. It actually plays a very important role in mobilizing resources and allocating them to productive channels. So it can be said that the process of economic growth of a country is facilitated by the capital markets. The important functions and significance of the markets are like this. The first and the foremost in them is the economic growth. The capital markets help to accelerate the process of economic growth. It reflects the general condition of the economy. Capital market helps in the proper allocation of resources from the people who have surplus capital to the people who are in need of capital. So we can say that it helps in the expansion of industry and trade of both public and private sector, leading to a balanced economic growth of a country. The second important function of the capital market is that it promotes savings habits. After the development of capital markets, the taxation system and the banking institutions provide facilities and provisions to the investors to save more. In the absence of capital market, they might have invested in unproductive assets like land or gold, or might have indulged into unnecessary spending. Then the capital markets provides stable and systemic security prices. Apart from the mobilization of funds, the capital market helps to stabilize the prices of stocks, reduction in the speculative activities, and providing capital to borrowers at a lower interest rate help in the stabilization of the security prices. And the very important function of capital market is to make funds available. Uh, See, investments are made in capital market on a continuous basis, and both the buyers and sellers interact and trade their capital and assets through an online platform. Stock exchanges like NSE or BSE provide the platform for this, and thus the transactions in the capital market become easy. Now let's understand what is the difference between capital market and money market. We shall be discussing these differences on six aspects. That is participants, instruments, duration, liquidity, safety, and expected return of both the markets. So let's start with participants. In the capital market, the participants in the market are financial institutions, banks, corporate entities, foreign investors, and ordinary retail investors from members of the public. Whereas money market uh, is participation is made by and large undertaken by the institutional participants such as RBI, bank, financial institutions, financial companies. You see that individuals are absent here, right? Um, then the second is the instruments in the market. That is for the capital market, the main instruments traded in capital market are equity shares, debentures, bonds, preference shares, etc. Whereas in the money market, the main instruments are short-term debt instruments such as treasury bills, trade bills, commercial papers, certificates of deposits, etc. Now let us talk about the duration, that the time limit through which we define. So the capital market deals in medium and long-term securities such as equity shares and debentures, whereas money market instruments have a maximum tenure of 1 year and may even be issued for a single day. Now, let's see how the liquidity is different between the two markets. Capital market securities are considered liquid investments because they are marketable on the stock exchange. However, a share may not be actively traded and it may not be easy to find a buyer for that share. But that doesn't mean that the entire market is completely always illiquid, right? So liquidity is available through market activity in the capital market, whereas in money market instruments, on the other hand, they enjoy a higher degree of liquidity as there is formal arrangement for this. The discount Finance House of India, now SBIDFHI, has been established for the specific objective of providing a ready market for money market instruments. So, degree of liquidity in money market is much higher in comparison to the capital market. Now, let's talk about the safety of the investments made in the both the markets. Let's compare that. See, in capital market, instruments are riskier both with respect to returns and principal repayment. Issuing companies may fail to perform as per projections and promoters may default investors. Whereas money market is generally much safer with the minimum risk of default. This is due to the shorter duration of investing and also a financial soundness of the issuer, which primarily are the government, banks, and highly rated companies. And the last, let's discuss about the expected returns in both the markets. See, the investment in capital market generally yield a higher return for investors than the money market. The possibility of earning is higher if the securities are held for a longer duration. Whereas money market is of short duration and it doesn't provide high return on the investment. So these are the differences between the money market and the capital market. The picture on the slide gives you an overview of how the capital market is structured in India. You can see there are government securities, industrial securities, development financial institutions, and financial intermediaries. And then there we have securities market divided into primary and secondary market. Then there are development institutions like IFCI, ICI, SFC, IDBI, etc. And then intermediaries provide you services like merchant banking. Then mutual funds are there, leasing companies are there, and government securities, are there, keep on issuing, bringing new issues to the market. Let us discuss this in a little detail. See, after independence, India realized importance of industrialization and opted industry as prime moving force. But to achieve this objective, there was a requirement of huge investment in the form of capital. Unlike in the industrialized Western economies, India's banking sector was not developed and it was very weak, small and geographically unevenly distributed. So to deal with this challenge, government decided to set up financial institutions which could play the role of banks till banks gain strength and presence to take the responsibility of project financing. Banks at that time were weak due to low saving rate and lower deposits from public. Uh, Institutions like IFCI in 1948, ICICI in 1955, IDBI in 1964, SIDBI in 1990, and IIBI in 1997 were established. All of them, except ICICI, which was a joint venture between RBI and some foreign banks and financial institutions, were funded by the government. But post 1991 liberalization, stock market became popular among the industries, and position of bank also strengthened as a source of fund. Compared to financial institutions, stock market provided easy and cheaper capital. After that, financial institutions became irrelevant. Thus, on the suggestion of Narsimhan Committee, when the government of India decided to convert FIs into the All India Development Banks, and in 2000 the government allowed ICICI to go for a reverse merger when an older enterprise is merged with a younger one. And with the ICICI Bank, it was first AIDB merged with no obligation of project financing. Presently, there are only four financial institutions operating in country as regulated AIFIs by RBI, that is NABARD, SIDBI, Exim Bank, and NHB. Investment institutions, that is government set up another set of investment institutions consisting of LIC 1956, UTI 1964, and GIC in 1971. But as soon as their investment related functions started fading away, government allocated them different segments. Now, LIC is a public sector insurance company in the life segment. GIC has been converted into public sector reinsurance company in 2000, and UTI was converted into a mutual fund company in 2002. It is now part of Indian financial fund industry, Indian mutual fund industry, and the lone such firm in public sector competing with other private sector companies. Apart from this, we have number of state level financial institutions, which we shall be discussing shortly in the next slide. That is the state financial corporations and the state industrial development corporation. Right, and then there are banking companies, insurance companies. We are just moving to the next slide to understand this a little deeper. Right, I would like to tell you here about the government securities market. See, the securities market are financial instruments raised to uh, securities are financial instruments to raise funds. The primary function of the securities market is to enable the flow of capital from those that have it to those that need it. Securities market help in transfer of resources from those with idle resources to others who have a productive need of them. The gilt edge market refers to market for the government and semi-government securities backed by RBI. The securities traded in this market are stable in value and are much sought after by banks and other institutions. The industrial securities market refers to market for shares and debentures of old and new companies. This market is further divided into new issues market and old capital market, meaning the stock exchange. Securities market are divided into government securities market and industrial securities market. Government securities market for both old and new issues has been on the over-the-counter market where securities of the union government and state governments were issued. And over-the-counter or the OTC market and an exchange market are the two basic ways of organizing securities market. In the OTC market, dealers act as market makers by quoting prices by which they will buy and sell a security currency or the financial products. A trade can be executed between two participants in an OTC market without others being aware of the price at which the transaction was completed. Let's move on to the next slide. So as I was telling you that it was on the suggestion of Narsimhan Committee 1 that the government decided to convert financial institutions into All India Development Banks. And in 2000, number of companies were converted, sorry, government investment institutions were converted into banks. That is, government allowed ICICI to go for reverse merger, and ultimately, from a number of development financial institutions in the post pre-liberalized era, we had just four institutions which are into development financing, like NABARD, SIDBI, Exim, and the Exim Bank and the National Housing Bank. Right. Then there are a number of investment institutions which the government brought forth, as I told you, that is LIC, UTI, and GIC. All of them have now changed their forms in the post-liberalized era, as discussed in the previous slide. Now, let us have a look at the state level financial institutions. To facilitate the growth and development at the regional level, government allowed states to set up their own financial institutions after the states demanded so. And there are many state level institutions such as state financial corporations or SFCs. These have been established under the Financial Corporation Act of 1951, and present there are 18 state financial corporations operating and providing long-term finance for setting up of the smaller projects within their region. The SFCs provide financial assistance by way of term loan, subscription to equity and debentures, guarantees, discount of bills, and seed or special capital. Then there are other type of institutions are there, that is the state industrial development corporations. These were set up under the Companies Act 1956 as wholly owned undertakings of the governments with the specific objective of promoting and developing and large industries in their respective states, union territories. Some of SIDCs also offer a package of development services that include technical guidance, assistance in plant location, and coordination with other agencies. Now, see, what are the resources to these state financial institutions? These institutions generally do not have very large resources to meet the growing demand of industry within their region. They raise resources by issue of share capital, issue of bonds and debentures guaranteed by state governments. Additional resources are raised by accepting deposits from public and by borrowings uh, from state governments. Other main resources available to these institutions are refinanced from Industrial Development Bank of India or SIDBI. Now, IDBI is not there, so this development facility, is not available to them. But SIDBI still plays its role. And then we have banking industry, which has emerged as a major source of debt fund to financing industrial projects. Now we shall discuss in detail about banking industry in a later lecture. Let's move on to another source, that is insurance companies. After independence, life and non-life insurance businesses were nationalized by the government in 1956 and 1970 respectively for the purpose of facilitating nation building. But after liberalization, there was need for the economic reforms in making industry competitive. Thus, the industry was opened for entry of private players in 1999. And since then, many private players have entered the industry. An independent regulator has been set up, that is IRDA, that domestic and foreign, with an FDI cap on 49%. Presently, Indian insurance industry consists of one public sector life insurance, that is LIC, four public sector general insurance, that is subsidiaries of GIC, like National Insurance, Oriental Insurance, and all, and two specialized public sector insurance like AICIL and Export Credit Guarantee Corporation of India, and one public sector reinsurance, that is GIC and private insurance companies. Right, and then we have securities market, that is uh, I just told you that they arrange and facilitate move of capital from those who have and to those who need it. uh, so we just spoke about the gilt edge market in the last slide, and now let us see the another kind of institution which is required to facilitate raising of fund in the capital market, that is merchant banking services. So as per SEBI, or Securities Exchange Board of India rules, a merchant banker refers to any person who is engaged in the business of issue management, either by making arrangement regarding buying, selling, or subscribing to securities, or acting as manager, consultant, or rendering corporate advisory in the relation to such issue management. Merchant banks may be subsidiaries of commercial banks, or may have been set up by private financial services companies, or may have been set up by firms and individuals engaged in financial uh, up by firms and individuals engaged in financial advisory business. Merchant banks in India manage and underwrite new issues, undertakes indication of credit, advise corporate clients on the fundraising and other financial aspects. Since 1993, merchant banking has been statutorily brought under the regulatory framework of SEBI to ensure greater transparency in the operation of merchant banks and make them accountable. Now let's understand the role of the regulator, that is Securities Exchange Board of India, in the capital market. Uh, See, it was set up, SEBI was set up in 1988, but did not have any legal status till May 1992, when it was granted powers to legally enforce its control over the financial market intermediaries. With the bloom of scale of actions in the financial market, there were a lot of malpractices taking place. Practices like a false issue, delay in delivery, violation of rules, regulation of stock exchanges were on rise. In the order to curb these malpractices, the government of India decided to set up a regulatory body known as SEBI. The role and objectives of the SEBIs are like number one, that is regulation of the activities of the stock market, then protecting the rights of the investors, ensuring the safety of the investment to prevent malpractices uh, in and curb fraudulent activities, and to develop the code of conduct for intermediaries such as brokers, mutual fund sellers, etc. Right. Now let's have a look at the recent developments in Indian capital market. The Indian capital markets have been going through various developments over the years, and most significant are One, new measures of risk management. Investments in the capital market are exposed to various risks, though some are systemic risk and others happen as a result of unsystematic market activities. Uh, so, first we'll talk about measures to reduce price volatility. Volatility is the function of price movements. It is the rate of up or down movement of the stock price. Volatility is regarded as negative factor for the markets as it represents uncertainty and risk. After the introduction of index futures trading in 2000, there was a relative reduction in volatility of the prices. Then there are circuit breakers. Circuit breakers were introduced to reduce the large sell-off and panic selling. Sometimes it is also called a collar. In an index of a particular, if an index of or a particular stock rises or falls a certain percentage of say 10%, 15% or 20%, trading is halted by the exchange in the stock or index for a certain period of time to curb the panic and check out for market manipulations. The second is the development is about investors awareness campaign. Uh, it was to make the market more secure for the investors. SEBI has introduced into investors awareness campaign by making official website for it, and investors are continuously advised to visit that. Then there are investigations, that is in case of any violation of the rules and regulations. SEBI Act 1992 investigation are carried out by SEBI, and let me tell you that these investigations take at a very fast speed. And then there is T plus 2 settlement cycle that is currently in the capital market. The settlement cycle is in the T plus 2 cycle. Here T means the trading day, and the T plus 2 settlement means the settlement and delivery of the shares shall take place in the second trading day after the trade take place. And then another very important development was ban on insider trading. Individuals possessing confidential information of a particular company can use the information to unethically profit from the stock market. SEBI has made it clear and mandatory to restrict all kinds of insider trading in the capital market. To prepare for this lecture, extensive references have been taken from the two books, which are Indian Financial System by M.Y. Khan, published by Tata McGraw-Hill, Delhi, and L.M. Bhole, Financial Markets and Instruments, published by Tata McGraw-Hill, Delhi. The video in slide 5 was taken from Corporate Finance Institute, titled Overview of the Capital Markets. Video YouTube link for the same has been given here. Thank you so much. Hope you enjoyed the lecture.